Welcome to Cherry Street Investor Education with Kavitha Baratakke, passive income coach and founder of Cherry Street Investments. Education that is designed for you to take control of your financial life. Join us to learn how you can create multiple passive income streams, diversify your portfolio, save on your taxes, and much more. Become a better investor and fast track your financial goals. Here's your host, Kavitha Baratakke.
Good evening, everyone, and thanks for joining in. I'm Kavitha Baratakke, and today I wanted to talk about smashing sixers in your investing game. Ajay actually insisted that I have a cricket reference here, so I usually call this all about syndications, or how to invest using syndications. For those of you who aren't familiar with syndications as a way of investing into real estate as well as other alternative investments, I kind of want to talk a little bit about why we do syndications, how we do syndications, and how you can benefit by investing in syndications to create passive income. I'm Kavitha Baratakke. A lot of folks on this call already know me. For those of you who are watching the recording, I started this company called Cherry Street Investments, and I'll talk a little bit about myself in a few slides. First, let's get to the agenda. What I'm going to cover today, there's a lot of content here, but hopefully you can digest it all. It's going to be kind of lengthy, but we'll get through it. So question one, why invest passively? A lot of people want to have great jobs, have great income. So why bother even investing passively? We'll talk about that. We'll talk about what is a syndication and who are the parties in a syndication and the typical return structures in the syndication. And typically what we do in a syndication, depending on, of course, it's an existing syndication or an existing property or a new build. We'll also talk about how the returns are, what kind of returns are usually in a syndication, types of syndications, types of investors in syndications. A lot of people ask me this question, who's an accredited investor, who's a sophisticated investor? So I kind of want to break that down a little bit and also talk about what are securities, how are these structured? So we have something called Regulation D, 506B versus C, and what's the difference between these two offerings? That's typically how most syndications are structured, with either a B or a C that you'll find out there. And what are the typical documents in a syndication, as also how can you diversify better using a syndication? Last but not least, I have some examples of syndications that I've done in the past, and I'll just briefly allude to it, won't go into any details. So a little bit about me. I moved here to the US in 1998. I'm from Bangalore, and my background is in computer science, just like anybody else. Got pushed into the engineering field, and I went to Texas A&M, did my master's, came to Austin and spent 20 years between IBM and Atlassian, and had worked very briefly in Wipro in India. I started real estate investments in 2009, and if a lot of you folks are familiar, we had this huge crash in 2008. So it was an opportune time in retrospect to start investing in real estate, and obviously the portfolio has done quite well. And I moved from single family to multifamily investing in 2015 and just never looked back. I financially freed myself from my job in 2019, actually much before that, but I just waited until I could vest all my stock. It's between us. And I transitioned to real estate full-time. I have about 2,200 doors. All that means is the number of units as a limited partner, which means I'm invested in them, as you will potentially invest in a syndication. And then 1,400 doors is like 1,400 units of multifamily, and that has since changed. We just bought another property, which is about 212 units last month. And we are closing on another property, which is 117 units this month. So I started Cherry Street Investments. My goal was to get syndications to more people, more accessibility, but I had to learn about syndication. I drove to Dallas, joined a mentoring group out of Dallas, spent 3 years commuting back and forth. So I felt like there could be better knowledge and better education out there, not just about syndications, but just as an investor. I wanted to know about taxes. I wanted to know about all these different things related to investment. So I try to bring a lot of different CPAs and attorneys to come talk about the different aspects of investing, as well as the legal and tax implications of it. And also come talk about different types of syndications, not just multifamily. I focus primarily on passive investments, and also have a life insurance license where I practice something called infinity banking. If you're curious, you can look it up. It's also called infinite banking. And it's a way or method to use a life insurance policy for investing, for college planning, for retirement, whatever you want. And I'm also a realtor in the Austin area. A lot about me. A lot of you folks know me, again, Cherry Street. I do passive, active, as well as life insurance policy, because it kind of ties in with this passive investments that we do. I focus a lot on education as well. So if you want to find any education, I have a whole channel on YouTube. Just a lot of every webinar that I've done, which is about 90 or 100 webinars, is on YouTube. So you can subscribe, check it out. A lot of information out there, not just me talking, but a lot of guest speakers that I have coming in and talking, everything from what if you have investments in India, how do you handle them? What are the taxation rules around that? And if you're a foreign investor, how do you invest here? A lot of different topics here. So what is passive income? A lot of people have great active income, which means they are actively working. If they stop working, their money stops working for them. So we want to create more passive income, which is money that you don't have to put any effort to maintain. You should be able to go on a vacation and still make money, and that's our goal. And I know a lot of you folks are looking for more passive income and to create that income stream. So today we'll talk about, is owning and operating rentals a truly passive activity? And what I found by investing into real estate, the only way I knew how was single family homes. And I realized that it's truly not a passive income activity, because there's a lot of effort I had to put into actually operating my rentals. So I started looking for how could I scale more, right? Like there's a question of scale. How many rentals do you have before you say, okay, this is way too much work for me. Now it's becoming an active activity. And versus how can I invest into something where the cash flow is coming in and I don't have to actively engage in any kind of work in that activity. So, and another thing to consider here is diversification. A lot of people, a lot of investors I see actually, this was sort of an aha moment for me when I started learning about diversification, because a lot of people I know, and myself included, half of my 401k was halved in 2008. And that is because all of my 401k was in the tier 4. All of my retirement, which is most of my assets, were in tier 4, which was 401k. And then I had some tier 2. In 2008, actually, I didn't have any homes. So I had nothing in any of these different tiers. And these tiers sort of represent how the wealthy invest, really. This is something that I got from my life insurance side of things, where if you look at how the wealthy invest, they actually put a lot into building the base of this pyramid. And then they go in and invest in direct investments that they can control, like a single family home, or they might be buying bigger buildings by themselves. Anything that you buy by yourself, including investing in yourself, is direct investing. Indirect investing is something like a passive investment in an apartment building or something that you don't have direct control over. And tier 4 is your speculation, or the stock market and the crypto market, where the returns are obviously really high, the risk is really high, but the control is really low, because you don't know when it crashes, you have zero control over it. So ideally, when we talk about diversification, a lot of us focus on just the stock market and say, hey, I've diversified across, I don't know, small, medium, mid cap, and large cap stocks. I've put some in global, I've put some in, international funds, and I've put some in REITs, and I'm diversified. So unfortunately, a lot of that diversification is still in tier 4. So you're not really exposing yourself to the other tiers, including having a good savings and protection plan if something happens to you. A lot of us have some savings, but they're sitting really underutilized in bank accounts. So Something to think about is how you're diversified, and is it mostly up here, in which case your pyramid is not really very stable. So why invest in real estate passively? One of the big reasons is the economies of scale. So if you're going to go buy 5 units, let's say by yourself, and they're spread across town, you just don't have the economies of scale to minimize the cost. So if you want to do property management, it costs you 8% or minimum, or maybe 6% if somebody's cutting you a deal. But there's costs in everything, and you have retail cost in fixing it up, retail cost in, you have any repairs or maintenance on it. So there isn't economies of scale, because when we get 100 units, 200 units together in one place, we hire a leasing agent for the property, we hire a manager for the property, we hire, staff for the property, because at that scale, it starts making sense. So essentially, our property management cost goes from 8 to 3% is what we typically pay on these properties. So that's just one of the costs, right? So we benefit from the economies of scale when we do larger apartments or larger investments versus smaller investments. You create truly passive income with little or no time effort, actually with no time and effort, because once you put in your dollar and that's it, from your perspective, if you're an investor or what we call a limited partner, you really don't put in any effort. You also get both cash flow and equity growth of the investment. Of course, there's cash flow only when there's an existing asset. Sometimes we have to build that asset to create cash flow, in which case the first couple of years you might not have the cash flow, but you will always benefit from the equity growth of the investment. It also provides superior tax advantages. This is a huge advantage for commercial properties. I mean, even apartments are considered commercial properties. And I'll talk a little bit about what cost segregation is and why it provides these huge tax advantages when compared to single family homes. Last but not least, again, you want to diversify your portfolio. And a lot of people don't realize that they can use their existing retirement accounts to actually diversify into real estate through something called self-directed IRAs or solo 401ks. And a lot of people don't know how to do it, don't know of it. So I want to talk a little bit about how you can diversify your portfolio better. So what is a syndication? It's simply, Google defines this actually as a temporary alliance formed by professionals to handle a large transaction that is impossible to execute individually. It is what it is. We go buy 200 unit, 300 unit apartments that you possibly could not go buy alone unless you were, you had $30 million or $40 million. But we pool in the resources and we share both the risk and the potential for good returns on those investments. And from an investor perspective, this is good for busy professionals who have full-time jobs and families, but still want that real estate exposure in their portfolio, but not really own single-family homes necessarily. So who are the parties in a syndication? We have the general partner. I'm usually on that side of the fence where we do underwriting. Underwriting is nothing but a fancy way of saying financial analysis of that particular investment, identification and acquisition of the investment. We work with brokers, lenders, we do the investor relations. Obviously, we have a pool of investors, sorry about that. We work with the attorneys because all these have to follow SEC rules. So we have to form the legal structures and the paperwork for these syndications. We cannot just willy-nilly open up a syndication without these structures. We also work with third-party or in-house property management. It depends on the property, it depends on the location. And we perform the ongoing asset management, which is basically managing the property manager, because we have a business plan for the property and we execute that business plan. When we buy a property, we actually provide a business plan to the investors, and we say, here's our plan for this property. And our goal is in the next 4 or 5 years, 3 to 5 years is typically how long this investment is for. And we provide monthly reports to the investors. We provide either monthly or quarterly cash distributions to all the investors. If it's an existing asset, if it's a new asset, obviously there's no cash flow until there is a real asset to produce that cash flow. We develop as well as track the execution of the business plan. So from that perspective, we are essentially buying a business. The apartment is a business, and then we come up with a business plan for the business to maybe take that business to the next level, reduce the income, increase the income, reduce the expenses. We don't want to reduce income, thank you. We also manage the disposition of the assets and the disbursement of the invested capital as well as the gains. So what is a limited partner? If you're an investor, you're considered a limited partner, which means you have limited abilities to exercise in the deal, meaning you're not doing the day-to-day operations of the deal. You do have voting rights, you do have a say, but you have a say as a collective rather than your vote is just one individual vote. You provide the cash investment, you get K1s, as well as the depreciation for the property, and that's really important, depreciation part. You get the cash on cash distributions, property reports. Usually you're an equity investor, although we have started structuring some of these where you get only cash flow and no equity in return for a higher cash flow and a higher, you're on the capital stack, you come in higher, meaning that you get paid first before everybody else does. You get a higher rate of return, but in exchange, you lose the back end, which is the equity gain or the appreciation of the property. So if you want a fixed income, let's say 10%, 11% income on your investment, and you don't want the backside, you don't care about any upside, then this is probably another way to structure it. So I just want to talk a little bit about typical return structures in a syndication. So we have two major ones, and I like the preferred return model, and I'll say why, but you will see both out in the marketplace. So you should be aware of both. The first one is called the preferred return model. In the preferred return model, 100% of whatever the preferred return amount goes to the investors. So let's say I tell you, hey, I'm going to do an 8 pref, which is 8 preferred return. That means if the property makes 8%, 100% of that 8% goes to the investors, 0 to the sponsors. If the property makes 10%, then the cash flow might be split after the preferred return in a certain manner, which is 70-30, 60-40, 50-50. Different people will structure it differently. So most common what you'll find is a preferred return between 6 and 8% and a cash flow split or an equity split of 70-30 after. That's typically what you'll find in the marketplace. Some sponsors who are experienced or who feel like they can pull it off, they will do 60-40, 50-50. Some mobile home park investments, 50-50 is really, really common. In apartments, 70-30 is more common. There's also a hurdle, something called a hurdle. So what the sponsor says is, if I'm able to return a certain IRR or a return on your investment, then after I'll change the splits. So let's say I say, hey, I return 13 IRR. Then the splits can increase from 70-30 to 50-50. So if I achieve 15 IRR, then I will change the splits to 50-50 after your 13 is met. So essentially, it's basically saying the sponsor wants to create a more incentivized program where if they achieve more and they exceed the returns, then they get a bigger share. So it drives the sponsor to do more. In the straight split model, which I don't personally work with and I don't want to work with, is that the cash flow is split between the agreed upon ratio. The problem here is, if let's say the sponsor says we're going to create an 8% cash flow and they don't meet it, they make 6%. You still split with the sponsor 80-20 or whatever that is. So essentially, I feel like it does not favor the investors. So I prefer that. I'd prefer not to do deals which are straight splits. Most models which do straight splits is either 80-20 or 70-30, which means it's just a straight split. Whatever profits it makes, it's split 80% for the investor and 20% of the sponsor, or 70-30. It can be structured with or without hurdles, similar to this one, but my preference is definitely the preferred return model. So let's talk a little bit about how these investments are structured. Usually we'll have classes of investments. So we might have the class investors in a class A as a class A, and the GPs as class B, right? And here is the 70-30 split. So 70% LP, 30% GP. We might have multiple LLC structures. So a lot of investors ask me, should they set up an LLC to invest into some syndication like this? And I say, yeah, if you want 3 layers of LLCs and you feel like somehow that will protect you, you might want to set it up. But otherwise, let's say this LLC owns the property. You literally have another LLC sitting on top, but at least have this LLCs. And as LPs, you really have very limited liability already in the project because the GPs take on the majority of the liability. Never almost ever comes to the LPs to take on the liability. So LLC investment is more for your own structuring. So let's say you got into a lawsuit and you don't want investments in your personal name. You'd rather keep it into an LLC to protect yourself. That's a great use case for having an investment, all your investments into an LLC, because that separates you from those assets. And if you have any questions, feel free to type them in the Q&A box and I'll get to it. We also usually set up a manager LLC of the general partners and the limited partners. We might not have this sometimes. We might just have 1 layer. Sometimes we have 2 layers. So I just wanted to put it out there so you're aware. So what is this usually syndication work? We have pre-acquisitions. We evaluate a lot of investments before we actually get one. Typically, we might have 25 offers out before we might get one, sometimes even 40. So we look at the deal location, we look at the market data, we do all the financial projections, make sure that the property meets our criteria, as well as look at growth opportunities for the project before we even consider making an offer on the property. We submit what's called a LOI, which is called a letter of intent. In commercial properties, you don't sign a contract. You don't write up a contract because you just initially submit what's called a letter of intent, which outlines the main elements of what will be the contract later. We also evaluate the financing because we have to get a term sheet from the lender. A lot of our cash flow analysis depends on the kind of terms we get for the debt. So it's important for us to know what the lender will lend, and the lender will lend based on where the property is, what is the occupancy of the property, how much money is that property making, what's the debt service coverage ratio, it's called DSCR. So essentially, how much income does the property make to cover the debt, right? They want to look at, and usually 1.25 is like the minimum DSCR or debt service coverage ratio they're looking for. We execute what's called a purchase and sale agreement once we have that property under contract. And we pay a huge, usually the earnest money deposit on these are millions of dollars. So acquisitions, we perform due diligence. So if that means a 212 unit apartment, we walk every unit. We get a company who walks with us. We do audits on every apartment. We do lease audits of every lease on the property to make sure the numbers are matching up. We do what's called a PPM, which is a private placement offering. We open it up to investors. We use attorneys to put these offerings together. We raise capital, which means the investor signs stocks and wires the fund. And finally, we go in and buy or build a property. So what does it look after we buy it? We execute the business plan. Now, that could be an existing property business plan. That could be a new build business plan, anywhere from 3 to 5 years, depending on market conditions. We update the investors. We provide monthly updates on the progress of the property or the financials of the property as well. We are very transparent. We share all our financials with the investors for existing properties, and also with new properties, we just share what's going on with the project. What did we achieve this month? What didn't hit the mark? So we make distributions for existing properties, either monthly or quarterly. And finally, when we are ready to sell the property, we we don't necessarily wait 5 years. A lot of people ask me, do you have to wait 5 years? No, we wait until we reach that return that we promised the investors. So if that happens in 2 years, we're happy to get out and recycle the capital. If investors want to stay in, we're happy to stay. So we usually take a vote. Sometimes we say, hey, the market's really good, we're going to cash in. So we will sell the property at that point. So what do the total returns look like? It's a combination of cash on cash returns. This is again existing bills, and equity returns, which is the appreciation of the property. The risk factors, what are the risk factors in this kind of investment? Sometimes cash flow can be impacted if increased vacancy happens or bad debt happens. So we had some Class C properties where we had a lot of bad debt, which means people are not paying on time. So we do have those risk factors, and we can have cash flow impacts from there. What I've generally seen is what we cannot pay, let's say in a quarter, sometimes we catch up on the back end or when we refinance the property. The diversification of the asset, obviously you have a tangible asset here that you can invest into versus a stock market investment. So it usually, real estate doesn't fluctuate like that, right? It is pretty constant. It might stabilize, it might, the cap rates might come down a little bit, but we haven't seen that happen in Texas markets. So let's talk a few terms in real estate investing, especially with the commercial real estate investments. A lot of you familiar with cap rates. I think you guys are pretty sophisticated investors. It's used for assessing real estate investments for their profitability. What it is it assumes that you pay all cash for the property, which obviously we don't, but that's how a cap rate is calculated. So let's say I take net operating income of the property, which is income minus expenses. And I have to point out here, expenses never include the debt. The reason it never includes debt is someone else can place a different debt. Like someone can come in and place a 3% debt. Someone else could place a 4% debt. So in commercial properties, we never take the debt service or mortgage payments into account. We calculate income minus all the other expenses except debt. And that's what's called NOI, or net operating income. So if you divide NOI by the value of the property that you paid, you get the cap rate. So if you, let's say, had an NOI of 100,000 and the value you paid or the price you paid was $1 million, you got a 10 cap property. What's interesting is that cap rate is usually dependent on the perceived risk of investing in a market. So for example, in Austin, people are willing to invest for $30,000 of income. They're willing to pay $1 million. What that means is it's a 3 cap market, right? People are willing to pay so much for a property that even though it's making just $30,000 in NOI, they're willing to pay for $1 million for that property. So typically Austin tends to be between a 3 and a 5 cap. So obviously the newer properties are sold for a lower cap, and then the more expensive, older properties sell for a little higher cap. So also lower supply, higher demand, and lower cap generally. So if you want to go, let's say, to Brownsville, you might get an 8 cap property. You used to be able to get a 10 cap property, not anymore. So what is forced appreciation? Forced appreciation is a concept that's very unique to commercial investments because you're able to control the increase in value of the property. How do you do that? In commercial properties, you can either increase the value of the property by increasing the amount of money that the property generates. So if you're familiar with single family homes, your value is dependent on the comparables or comps of the property, which is what the neighbor's property or the subdivision, someone's house in the subdivision sold for potentially, right? Similar property. But here, our property value is dependent on the net operating income of the property. So you can increase the value of the property by increasing the net operating income. Conversely, you can increase the NOI also by decreasing expenses, or you can do both. You can increase income and decrease expenses, increase the NOI, And given that the cap rate for the market is a constant, if you increase NOI, your price has to go up, right? So let's look at an example. I purchased a 20 unit for $1 million. I had a rent of 1K per month per door. So that's 20K per month for all the 20 doors. So that's 240K a year. Now my expenses, I'll just assume it's 140K a year. And remember, expenses never include debt, right? No mortgage payments. So it's property taxes, insurance, repairs and maintenance, property management. There could be other fees, legal fees, whatever else. So your NOI is now 100K. So your purchase cap is NOI divided by purchase price. You bought it for $1 million, so it's a 10 cap. Let's look at the sale. We increase the rental income by $50 a door, which is per unit, right? So 50 times 20 units times 12, which is 12,000 a year. So let's assume we don't even increase it by 50 in 1 year. We increase $25 each year, which is very easy to do in most markets. Now we also, on the other hand, we increase income, we reduce expenses. So we drop the expenses by 8K. Let's assume that the landlord was paying for water and they decided they'll bill back water to the tenants, okay? So we reduced our expenses by 8K. Now your new NOI is that 240K a year, right? And now you added 12K to it. So it's 240 plus 12 minus 140 minus 8. 140 is your original expense. You reduced expenses by 8. So you have a 120K new NOI. Now, how do you calculate the value of this apartment now? Remember, I told you, let's assume that the cap rate of the market was still a 10%. Now your value is NOI divided by 10, which is 1.2 million. So just by increasing rents $50 a door on a 20 unit, you've increased the property value by 200K. That can happen within months, right? That can happen in 2 years in this case. So imagine now this $1 million property was 20 million. Obviously, we are able to scale up this increase in value quite a bit. So that's sort of the technique we adopt in most of these investments. So for a $10 million apartment building, you can achieve a $2 million increase, even if the market didn't appreciate. This is not assuming market appreciation. What does market appreciation mean in multifamily? It means the cap rates become smaller. So can you imagine if you divide this by 8 instead of by 10, now your new value becomes even higher. So we never assume in our calculations that the cap rates actually become lower, which means the cap rate compresses. We actually assume that the cap rates expand, which means we assume that the market is not favorable and we do all our calculations. So let's talk a little bit about depreciation. For those of you who own single-family residential assets, single-family homes, you're probably familiar with the concept of depreciation, where essentially you take the value of the structure itself and you depreciate it over 27 and a half years, because IRS says it's 27 and a half years. So if you had a total value of 200K, a land value of 75K, your depreciation is now 200 minus 75 divided by 27 and a half years, which works out to about $4,545 per year. So essentially your tax saving is whatever your marginal tax rate is of that depreciation, this amount every year. So not a huge amount, right? So let's talk a little bit about the depreciation of commercial assets. Usually, actually, most commercial structures are depreciated over even a longer period. So it doesn't seem like it should be very favorable for depreciation. But there is a tax incentive called bonus depreciation that allows a business to basically take a lot of the depreciation in the first year of the purchase of the asset, rather than over the life of the asset. So it's combined with another tax incentive, or a sort of, it's more like a tool, not a tax incentive, called cost segregation, to get a huge amount of depreciation on your investment. So I believe I have an example of it, but we'll go through this. What is cost segregation? So essentially, let's assume that you have an apartment building and you have plumbing fixtures, you have lighting fixtures, you have roof. Now, if you didn't all club them as one structure, if you did club them as one structure, then you could depreciate it over 27 and a half years for a single family and 39 years for a multifamily or a commercial building. But if you split those structures up into roof, which is a 10-year depreciation schedule, into plumbing, which might be a 15-year depreciation schedule, into electrical, which might be another 10 years. So essentially, you break that down into subsystems that are depreciated on a different schedule. And then what it allows you to do is it allows you to accelerate the depreciation in over a shorter period of time. So for example, if you take appliances, they have a useful life really of only 5 years, according to IRS. So you don't need to depreciate that over 39 years. You depreciate it over 5, right? So you can get a big chunk of depreciation up front. So what IRS allows you to do now is to actually take that anything less than a 15-year schedule in 1 year. So typically, just to give you an example, if you do a $100,000 investment, we generate between 60,000 to 98,000, sometimes 100,000, 100% depreciation in 1 year. So that's basically a negative income on your K1 in the first year. So that's how powerful it is, and you can use it to offset other kinds of passive income. So what are the types of different types of syndications? What are the different types of investors? And we'll talk a little bit about the different types of investments. So types of syndicated real estate investments. We have value add play. This is what I mentioned right now. We take an existing property and we add value. We upgrade older units. We might buy 80s property and upgrade the units. We increase the rents. We reduce expenses. Obviously, that requires dollars to execute. We have a hybrid. Actually, I should talk about an yield play before I talk about a hybrid. An yield play is that property is appreciating as is, it's cash flowing as is. We buy a property for its cash flow. It's really difficult in hot markets like Austin, Dallas, and all these big markets, but it's possible in smaller markets. Like you could go to Brownsville and possibly get like a 7-8 cap property and it'll cash flow really well. We have a hybrid approach where we take advantage of potentially good cash flow, but that doesn't stop us from adding value to the property to increase the NOI. Finally, we have new build. We've been doing a lot more of this in hot markets like Austin, Atlanta lately, because it's so hard to get into a good deal and people are overbidding and overpaying for properties. So we have this whole concept called build to rent, which we build a whole apartment, basically one level, like single family homes, but we rent the entire thing. We build to sell. We stabilize apartments and then we sell it to REITs and pension funds. Obviously, with new builds comes low maintenance, no cash flow during construction, as well as stabilization when we are occupying the apartment with investors or with tenants. Obviously, there's no cash flow at that time. So who's an accredited investor? The Security and Exchange Commission defines this person to be someone who's exceeded 200,000 income for each of the last 2 years, or 300,000 with the spouse, and reasonably expects the same for this year, has a net worth over $1 million, but that cannot include their primary residence. So folks in California or even Austin nowadays, I mean, $1 million house is not that uncommon anymore. It used to be. You can include your personal residence in your net worth calculation, but if you move it and rent it, then it calculates, it comes into your net worth calculation. It doesn't have to be an investor, individual. It can be a trust, a bank, a partnership. One thing I want to say is if you form an LLC with say 3 people, all the 3 of them have to be accredited for the LLC to be accredited. Who's a sophisticated investor? SEC requires us to work with either accredited or sophisticated. We don't want to take people into an investment who don't understand how to invest or who have not invested before into anything. We don't want them to take their last dime and put it into these kind of investments. So we definitely screen people, we have a chat with them. So what they define it is have enough knowledge and experience in business matters to evaluate the risks and merits. No income requirements for sophisticated, but we can only take up to 35 sophisticated investors in any investment. So what are securities? Tradable financial instruments, which we use to come in and raise capital in public and private markets. So we essentially provide three types of securities: equity, where you get ownership rights, you get the back end, you get debt, or you have debt. Essentially, you just become a loaner. You get a certain fixed percentages, and that's it. Or hybrid, where we combine aspects of debt and equity. We have to be either registered with SEC or we have to meet an exemption. The most common exemption you're going to find is called Reg D. And Reg D is something we all file, and we have to file what's called a Form D for all of these securities that we put together. So typical documents you'll find is PPM, or Private Placement Memorandum. And an investor asked me this, and I thought this is a good thing to mention here. He said, why does this say all the ways this can go wrong? It makes me really scared. And the point is that SEC wants us as sponsors to be able to tell the investors all the risks that are involved, right? And we are required by law to outline all those risks possible. That market can change, this can happen, and that can happen. Does it mean it'll happen? Probably not, but we can predict what nobody saw COVID coming, right? So we are required by law to disclose everything we know, as well as disclaim and all the ways that the deal can go wrong. Doesn't mean it'll go wrong. We have the operating agreement, which is the rules and procedures of how we'll operate that LLC that we're setting up, which will buy the property, and how disputes will be resolved. So let's say one of the partners is not performing. We could potentially get together as LPs, limited partners, and remove that partner. So there are all sorts of documents that tell you how this can be achieved. Then there is subscription agreement, where the investor legally commits to a certain amount of investment, a dollar amount of investment, and the number of units that it amounts to. And we also have an investor questionnaire, and that's there again for a good reason, where how do we know this person? Do we know that they're sophisticated? Are we able to evaluate that these people can make an investment? They're not putting their last dime on the line, right? There are certain investments where we're required to only have accredited investors. And then finally, typically we lay out the business plan. We say, here are the sponsor credentials, here are the financials, here are the returns, here's the whole period, all of that shebang. So 506B versus C, what's the difference? So in a B, we don't have to check if you're accredited. We can only allow, although only 35 sophisticated investors. So we do still ask you if you're accredited or sophisticated. A C, on the other hand, is open only to accredited, and we actually have to do a third-party verification of this accreditation. Typically, we use something called Verify Investor. You could also submit a letter from your CPA or attorney saying that you're an accredited investor. Here, it's called self-accreditation. So if you tell me you're accredited, I have to believe it. I don't have any need to go in and check. SEC doesn't ask us to, but we do still ask if you're accredited, because we do have a limit on the number of sophisticated investors. You do require a substantive relationship with the sponsor, which means you need to know who you're investing with. We cannot promote these on social media. An investment which is 506B cannot be promoted on social media or any other public platform. Whereas here, we can just take anybody who comes in. It can be freely promoted. Usually, you'll see this in crowdfunding platforms. So how can you syndicate, diversify your investments using syndications? You can do cash investments. You can do self-directed IRA investments. So a lot of you folks might have left a job, have an old 401k sitting around. you can roll that in and use it for investing into real estate. You can buy gold with it. You can buy silver. You can buy anything you want with your money. And not a lot of people don't know about self-directed IRAs. There is something called UBIT, called unrelated business income tax, that may be charged on the leverage portion. I'm happy to talk to you more about this. I also have an article that I've written on my blog about self-directed IRAs and UBIT. What I do recommend is folks going towards solo 401k, because it's just the simplest thing to set up. You have 100% control. You actually get to cut the checks from your own 401k. And yes, you can have a solo 401k and an employer 401k at the same time. But there is something required for a solo 401k, so you should have an active income business. And now the question is, what qualifies as an active income business? I'm happy to discuss that with you. But typically something like, let's say you have a rental property and you're managing that rental property, that's an active income business. And let's say you pay yourself a property management fee, that qualifies as an active income business. A solo 401k has no UBIT and tax-free growth and taxed at withdrawals unless it's a Roth. Similar to a regular 401k, you can have a pre-tax 401k and you can have a Roth 401k. Example of a recent investment, we had an existing multifamily 117 unit. We just closed this investment. Actually, we haven't closed it. We just closed it for funding. A-class built last year. Just wanted to give you guys an example of how these numbers work on this. So 21.5 million, we are getting it about 183 a door. We are going to add some value, not really rehab because it's a 2020 build, but we're doing some electric, chargers. We're doing some high-end amenities because it's a luxury apartment. This is our down payment. We have some closing costs. We have total equity here. So financing, 77% of it was financed. We got a 16 million loan. Interest rates are right now, we get anywhere from 2.47 on a US deal coming up soon. We're getting 2.47 on it right now. That's the initial lender quote. We got this at 3.2. We do have prepayment penalties if we pay the loan quickly. Typical investor returns about 85% over 5 years, which means if you put $100,000, you get $185,000 over 5 years. And we try to be very conservative on these projections. We usually try to beat these projections and exceed that 85% return. Cash on cash average on this was 8%. Recent townhome builds that we had, I know some of you we've been talking about that. You just pay a down payment, you get a discounted price to buy your own townhome. A lot of people like this when they want to really have a direct investment and control that investment. So I like to do a mix of both. I work on different kinds of projects to give my investors a mix of both. All right, I think that's it. And I am opening it up to questions. And I believe everybody's allowed to talk, so please ask me questions. You can unmute yourselves and ask a question, or you can type a question in the chat box or the Q&A.
So Kavitha, is there an interview or something that you have to do to figure out who's accredited and who's sophisticated, and then figure out whether you can take their investment or not? And is that only allowed for limited partners or general partners as well?
So general partners don't have to have accreditation or they have to be sophisticated, obviously. If the general partners in a deal, they already know what they're doing. Okay. But they don't have to be accredited necessarily, because the idea is that you have to be educated. They don't want people to be uneducated about the investment. So yes, depends on the deal, right? If it's a 506B, I can take in non-accredited investors. but I just want to make sure that they're sophisticated enough to realize, okay, the risks and merits of the investment. If it's a 506C, which we do structure sometimes, then yes, you have to be accredited, and we'll actually do a third-party verification. You have to submit all your documents to them, showing either your net worth or your income qualification. I hope that answers the question.
No social platform?
Sorry?
Is that because it's not on the social platform? You cannot do that in the social platform or crowdfunding. That's why you have to aggregate.
So the B is not on a social platform. You'll never see me advertise like the project that we have, for example, in Round Rock to buy the single family townhomes. We don't advertise that because it's a B offering, but it's open on the other hand to both sets of investors. So I don't have to verify your accreditation. But if I structure it as a C, then I have to verify, but then I could go blast it on social platforms.
Okay.
So hi Kavitha, this is Bali here. I had a quick
Hi,
question. So what are the exit strategies in these scenarios? That is, if as an investor your money is locked for what, 4 years, or what's the
Typically
product?
3 to 5 years in most
Okay.
investments. So what we tell people is, yeah, you could potentially give your interest to someone else, assign your interest the right way. But the question is, let's say you're 2 years into the investment, how do you know what it's worth? Like, what's your value proposition? Like when you sell it to someone or give it to someone, how do you know what you're going to get paid for it? That becomes a catch, because there is no valuation. Like I can go appraise the apartment building for you and tell you, hey, this is what the property is worth today. So that's the problem in reassigning these interests. But a lot of times, a lot of people are willing to just stay in it because they are getting cash flow. They want to create passive income, and this serves as a good way. And honestly, a lot of investors will tell me, hey, I don't want to remove the money because then I'll be hit with the tax implication on sale. So I'd rather just you keep rolling my funds over and just keep the property as long as you want, but keep paying me 8-10% a year, because I'm not making that money anywhere else.
Got it. So you mentioned it's 3 to 5 years. So I mean, it's a project, it's construction and all that, right? What happens when there are delays, for example, permits, utilities, sewage, and all that? If there's a potential delay, you still promise to still pay that 8%, or how does that work?
So the 8%, we don't typically pay on construction projects.
Okay.
We usually pay the construction projects only when we go to the stabilization phase, meaning, let's say I have to have a building, I have to have it occupied for me to make any money, right? So that 8% pref really doesn't come into play on most of these new builds. They mostly come into play for existing builds because we walk into with day one cash flow.
Got it.
Any other questions? All right. I hope that was useful then. And if you have any questions, feel free to reach out to me. Here's my contact information. A lot of you folks already have this information, but just in case you don't, here it is. And thank you for having me, and great talking to all of you. Have a good evening, everyone. Hi, I'm Kavitha Baratakke. I hope you found this video useful, and if you did, please don't forget to subscribe to my channel so you can get notified of any future videos I upload. I plan to cover a lot of investor education on this channel, and I hope you'll stay with me for it. If you have any feedback on future content you'd like to see me cover, please drop me a note or a comment on my video. Thank you for watching, and thank you for supporting me.